Top 10 Most Significant Financial Reforms in U.S. History. Throughout U.S. history, various financial reforms have been implemented to address economic crises, protect consumers, and ensure the stability of the financial system. Here's a look at 10 of the most significant financial reforms that have shaped the landscape of American finance. 1. The Federal Reserve Act, 1913. This act established the Federal Reserve System, the central banking system of the U.S. It aimed to provide a safer, more flexible, and stable monetary and financial system, helping to manage inflation and economic stability. 2. The Glass-Steagall Act, 1933. In response to the Great Depression, this act separated commercial banking from investment banking. It was designed to protect depositors' funds from risky investment practices, though portions of it were repealed in the late 1990s. 3. The Securities Act, 1933. This act was enacted to regulate the securities industry and protect investors. It mandated full disclosure of financial information to investors and established the Securities and Exchange Commission, SEC, to oversee securities transactions. 4. The Social Security Act, 1935. This landmark legislation created a safety net for the elderly and unemployed. It established Social Security, providing retirement benefits and unemployment insurance, which has had a lasting impact on the American economy and social structure. 5. The Fair Labor Standards Act, 1938. This act established minimum wage, overtime pay, and youth employment standards. It aimed to protect workers' rights and improve labor conditions, contributing to economic growth by increasing consumer purchasing power. 6. The Securities Exchange Act, 1934. This act empowered the SEC to regulate and oversee the securities industry, ensuring transparency and fairness in securities markets. It aimed to restore investor confidence following the stock market crash of 1929. 7. The Dodd-Frank Wall Street Reform and Consumer Protection Act, 2010. In response to the 2008 financial crisis, Dodd-Frank aimed to reduce risks in the financial system. It implemented stricter regulations on banks, created the Consumer Financial Protection Bureau, CFPB, and enhanced oversight of financial institutions. 8. The Consumer Credit Protection Act, 1968. This act aimed to promote informed use of consumer credit by requiring disclosures about loan terms and costs. It established the Truth in Lending Act, helping consumers make more informed financial decisions. 9. The Bankruptcy Abuse Prevention and Consumer Protection Act, 2005. This reform aimed to make it more difficult for individuals to file for bankruptcy. It introduced mandatory credit counseling and stricter means testing, attempting to curb abuse of the bankruptcy system. 10. The Tax Cuts and Jobs Act, 2017. This act significantly overhauled the U.S. tax code, reducing tax rates for individuals and corporations. While it aimed to stimulate economic growth, it also sparked debates over income inequality and long-term fiscal implications. These financial reforms reflect the evolving needs of the U.S. economy and the ongoing efforts to balance consumer protection, economic growth, and financial stability. Each reform has played a crucial role in shaping the current financial landscape and addressing the challenges faced by American society.